Imagine this. You wake up morning, check the news, and see gold falling, silver falling. But the world's economy? Still uncertain. Inflation? Still biting. Wars, elections, debts, everything that should make gold explode. Yet it's collapsing. Something doesn't add up, right? People have always called gold the ultimate safe haven, silver the poor man's gold. But lately, these two ancient guardians of wealth are losing guard duty. Why? What's quietly killing their shine, even as global chaos seems louder than ever? That's what we're unpacking today. Why it matters now. Because gold and silver aren't just metals, they're symbols of trust. When they fall, it's not just prices changing, it's psychology shifting. You see, every time gold drops, someone somewhere loses faith in fear itself. And when silver sinks, small investors, especially in emerging markets like India, start asking, did we miss the timing? Or is the game changing?
A short story of false safety. Let's rewind to early 2020. Markets crash. Panic spreads. What happens? Gold soars above $2,000 an ounce. Silver follows. Fast forward to 2024. Same headlines. Recession fears, global tension, inflation. But this time, gold rallies for a few weeks, then stalls. Silver never takes off. It's almost as if investors are saying, we've seen this movie before, and we're not buying the sequel. The hidden mechanism. Here's the first twist. Most people think gold's price rises or falls because people buy physical gold. Not true. Nearly 90% of daily gold trading happens on paper, in digital contracts called futures. Big institutions, banks, funds, traders are essentially betting on the price, not buying the metal. So when inflation numbers, interest rate announcements, or the US dollar index shift even slightly, these traders move billions in minutes. And gold, that ancient silent metal, dances to the rhythm of digital money. It's not emotional investors moving gold anymore. It's algorithms.
The interest rate trap. Here's what's happening beneath the surface. When central banks raise interest rates, bonds start paying more. So instead of storing value in gold, big investors park their cash in US bonds, because now they earn returns and stay supposedly safe. Gold pays no interest. And silver? Same story. So as money chases higher returns, these metals lose buyers, even if the world feels unstable. That's irony number one. Fear might be rising, but greed is paying better. The dollar domino. Gold and silver prices are always quoted in US dollars. When the dollar strengthens, even if only by a few percent, it makes gold more expensive for buyers in other currencies. Demand falls, prices dip. Now, who strengthened the dollar recently? The US Federal Reserve. By hiking rates, they made global money flow back to America, draining gold demand from Asia and Europe.
It's like the Fed didn't touch gold directly, but it pulled the invisible strings behind it.
Let me ask you something. Do you think gold still deserves its title as a safe haven, or is it becoming just another market asset? Tell me your view in the comments. I really want to read it. And if you want clear, story-driven breakdowns like this every week, subscribe, because the next few months might shake every assumption you've had about markets and safety. The demand mirage. You might hear reports, India's gold imports are rising, or China's central bank buying gold. True, but here's the catch. That buying hasn't offset the selling from ETFs in Western markets. When big funds unload their gold holdings, even a small percentage, The digital volume they remove is huge compared to physical buying in Asia, so the net pressure stays downward. It's like millions buying bangles, while billions are leaving paper gold. The industrial shadow on silver. Silver is even trickier. It's not just a precious metal, it's an industrial one, used in solar panels, electronics, batteries. So when global growth slows, when factories cut output, demand for silver drops suddenly. The metal that should rise with inflation ends up falling with recession fears. That's irony number 2. Silver can't decide if it's gold's cousin or copper's colleague. The investor psyche flip. During the 2010s, investors thought bad news for the world equals good news for gold. But in the past few years, it flipped. Now, bad news often means central banks will raise rates, currencies will move, liquidity will shift, and gold falls before it rises. Essentially, fear now causes confusion, not clarity. The quiet humor of timing. People still queue to buy gold on festive days, Diwali, Akshaya Tritiya, even if prices are sliding that very morning. Why? Because tradition beats timing.
Meanwhile, large global funds sell gold minutes after a Federal Reserve tweet updates its outlook by 0.5%. It's almost poetic. Faith versus formula. The uncomfortable math. Let's summarize with painful simplicity. Right now, global inflation at around 4 to 5%. Gold returns in the last year, barely 1 to 2%. Short-term U.S. bonds, paying 4 to 5%. So investors ask, why hold gold earning 0 when bonds pay real cash? That arithmetic, not emotion, is quietly killing the shine. But let's zoom out. Every metal cycle eventually turns. When interest rates start to drop again, maybe in late 2026 or 2027, the game flips. Dollar weakens. Gold regains demand. Silver surges with recovery. That's the quiet trap of time. When everyone gives up, the next wave begins. So maybe the real question isn't, why are gold and silver falling? Maybe it's, why did we start expecting them to always rise? Because behind every safe haven lies a simple truth. Nothing is safe forever. Not even trust itself. When that cycle turns again, remember this conversation and ask yourself, who will be brave enough to buy when the shine looks gone? Bye-bye, guys. See you soon. Also say for comment and subscribe at the mid of script, not directly. Make some question and query for comment and make a strong reason for subscribe. Narrative flow to enforce. Strong cold open. Clear setup of why this topic matters right now. Step-by-step breakdown of how the system works. Reveal the uncomfortable math or hidden mechanism. Contrast hype versus reality. Zoom out to bigger implications and risks. End with an unresolved question or thought-provoking conclusion. Rules: no filler, no motivational talk, no obvious clickbait, no emojis, no headings unless naturally spoken. Write exactly for the requested length, pacing-wise. Assume the viewer is intelligent but not an expert. The script must feel like a premium YouTube explainer that keeps viewers watching until the final line.